If you're using a target date fund inside of your 401k, then you're likely leaving money on the table. In today's video, I'm going to show you how you can look to do better than a target date fund inside of your retirement portfolio. Hey everybody, I'm James Conole, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. So what is a target date fund? Well, when you go to invest in your 401k provider is going to give you a whole bunch of different investment options to choose from. They're going to say you can choose from these large company funds, small company funds, international, real estate, bond, etc. And they say you can either design your own portfolio or you can choose a target date fund. And a target date fund is going to be a fund that corresponds with the year that you think you might retire. Now here's the difference between the two of them. Whereas a normal fund, you pick a large cap growth fund, for example. It's going to be directly owning individual stocks that fit the large cap growth asset class. If you choose a bond fund, it's going to be owning individual bonds that fit the parameters of that fund. If you choose a target date fund though, it's not actually directly owning stocks and bonds for the most part. What it's doing is it's owning multiple other mutual funds that are then owning stocks and bonds or assets that you want to have in that target date fund. Let's take a look at an example. Now, this isn't a recommendation, but what this is showing details of the Vanguard Target Retirement 2030 Fund. So this fund was designed for someone that thinks they might want to retire around the year 2030. Now, if we look at this, what we'll start to see is if we go to the portfolio composition, this fund isn't actually directly owning stocks or bonds. It is owning about 64% stocks and 36% bonds, but it's doing so by owning other mutual funds. So for example, there's 39% in the Vanguard Total Stock Market Index. There's 25.5% in the Vanguard Total International Stock Index, 24.7% in the Vanguard Total Bond Market Index, and finally 10.8% in the Vanguard Total International Bond Index. So you as an investor inside of your 401k, you can go individually combine these different mutual funds to build a portfolio that's right for you, or you can select a target date fund. And this target date fund will say, if you're going to retire around this year, here's maybe generally a portfolio mix or mix of different funds that we think is most appropriate for you. Now, there are some benefits to this. Number one, you don't really have to think about it. You choose the year that corresponds with your retirement year, and this portfolio is going to be managed that way. The second benefit is it's professionally managed. You don't have to worry about, is this going to be way off track, or is this going to be too speculative or too aggressive or way too conservative? At least within reason, you know that this is going to be a professionally managed fund. And number three, it's going to be more aggressive or more conservative based upon your time horizon of when you're going to retire. So those are the benefits of target date funds. The downsides though are this. Number one, it's cookie cutter. Just because you're going to retire in 2030 and another individual is going to retire in 2030 doesn't mean you should have the same exact portfolio. Unless your income sources in retirement and your expenses in retirement and your lifestyle in retirement and your tax situation in retirement and your risk tolerance in retirement, unless all of those things are the exact same, you probably shouldn't have the same exact portfolio. Now with a target date fund though, it's going to manage fairly generally. You and every other individual in that 2030 fund, you're all going to have the same portfolio. So it's a cookie cutter approach that might get you close to where you want to be, but very rarely is it going to be the perfect allocation for where you are, what your goals are, and what your risk tolerance is when looking at retirement. The second downside is depending on the provider, these funds might actually be fairly expensive. So if you go back to what I said earlier, most mutual funds, if you're owning a large cap growth fund, for example, it's going to have one internal expense, and then it's going to go own the different stocks that you want to own in your portfolio or that it wants to own in that portfolio for you. With a target date fund, depending on the provider, you may have the expense for the fund itself, and then you might have expenses for the mutual funds it is then owning. So because there's two layers of fees there, what you're getting is the target date fund's internal expense, plus you're paying the mutual fund expense for the underlying holdings. Not every provider is like this. Some providers are very good about condensing those expenses or even eliminating the expenses at one of those levels, but some providers, you're double paying because of that. And the third downside, and to me, this is my biggest concern with most target date funds, is they tend to get too conservative too quickly, in my opinion. Let's take a look at an actual example. Now, what we're looking at here is this is an actual example from one of the main providers of target date funds for many retirement plans around the US. What this is looking at is it's called the glide path. So you see when it says retirement glide path here, what that means is if you choose a target date fund that corresponds with the year that you might retire, you can do that down here. So let's take a look at this. Let's assume that you are in the Retirement 2040 fund. What that means is you are going to be mostly in equities, so mostly in stocks that year, but as you get closer to retirement, that level of stocks is going to fall, and it's going to fall to about 55% by the time that you actually retire. So 55% in stocks, 45% in bonds, and then it's going to continue to fall. At least this provider, it's going to be about 35% to 40% stocks 25 years into retirement. Now, as we look at this, in my opinion, gets far too conservative far too quickly. For one, if we go all the way back to 2065, now that's someone who has a 40 plus year time horizon. You can see it's not much, but there is a little bit here that's in bonds. Now, if I have 40 years to go until retirement, I might not want to own any bonds. That might be a drag to my portfolio. Obviously, your personal risk tolerance and other factors come into play here. But to me, this whole section here, all these bonds, whether you're 2060, 2065, 2055, I don't want that personally in my portfolio. And depending on the investor, they might not want it either. That's part of the problem. But the bigger problem, in my opinion, is this inflection point right here. What you can see is at this point, the level of stock starts dropping pretty dramatically so that 20 years out, you start decreasing your stock exposure. Now, to me, 20 years is still a very long time until retirement, certainly a long enough time where you can expect a greater return from stocks than you can from bonds. Now, obviously, this is one of those things that needs to be unique to your personal situation. You may have a personal preference for more stocks or less stocks. But as we're looking at this, one of the things I find over and over and over again is people are unaware of how conservative these portfolios actually get, to the point where with this provider at this year, the year you retire, to be 55% stocks, 45% bonds, that's a really large portion of your overall portfolio invested in something pretty conservative and not investing in something that can help to keep growing and keep up with inflation for you over time. So what should you do? If a target date fund isn't the best answer for your 401k, what is there? Well, for one, be more intentional. Don't settle for a cookie cutter solution that's not going to be unique to you and your specific goals. How do you do that? Well, for one, don't base your mix of stocks and bonds on your age. Just because you're the same age as someone and going to retire in the same year as someone doesn't mean that you have the exact same outside income sources. It does not mean you have the exact same expenses in retirement. It does not mean you have the exact same comfort level with investing. So don't just start with your age as an arbitrary point for basing your stock to bond allocation. Number two, start by understanding when you'll actually need these funds. Let's say, for example, you're going to retire at 60, but from 60 to 70, you're going to live on cash and brokerage accounts so you can implement a Roth conversion strategy. Well, should your fund be earmarked or should it be designed to start providing income at your age 60? Or should it be designed to start providing income at age 70 and beyond, which is when you're likely to actually need it? So your retirement year doesn't always correspond with when you actually need these funds, but with target date funds, the stock to bond mix is entirely based upon your retirement year. Focus less on your year of retirement and focus more on when you'll actually need these funds so you can design an allocation that's more in alignment with your needs, not just an arbitrary retirement date. Side point on that, one of the worst things I see people do is have these target date funds in their Roth IRAs. Even if you're going to retire at 60 or 65 and your target date fund is aligned with that, well, in your Roth, you might not touch those funds till 70, 75, 80 or beyond. So make sure, and this comes back to asset location, make sure that you're invested the right way in each account and understanding the time frame from when you'll draw assets down from each of your retirement accounts. And then number three, customize your retirement portfolio. Have enough conservative investments to be able to give you income regardless of what the stock market's doing. Have enough growth assets to make sure that you're keeping up and outpacing inflation over time so that your standard of living continues to rise. Have that be intentional to you, not just based upon, again, an arbitrary cookie cutter retirement date fund. So that's an overview of target date funds. And if you're thinking like more of an overview of how to design that perfect strategy for yourself, be sure to check out this retirement investing playlist above. Once again, I'm James Conole, founder of Root Financial. And if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.